Hey, good afternoon. I hope my audio is coming through clearly. If somebody can confirm that you're able to hear me, the chat box will be good. Thank you. Thank you. Excellent. So firstly, a very, very warm welcome to all of you for joining us on a weekday at 4 p.m. I know it's not easy, but we thought it's a very important topic, and it's a topic which has attracted a lot of attention over the last few years. Last few weeks specifically, given the changes that have been unfolding on the NPS, the NPS business. I think the primary objective behind today's session is really to sort of highlight to all of you as to the changes that have already sort of been unleashed. What does it mean to some of you? I know this is a fairly this is a homogeneous mix of our subscribers, potential subscribers, those of you who are considering empaneling for NPS. Some of you are, I'm sure, our corporate partners as well. So a warm welcome to each one of you. And what we will try and do today is to try and sort of demystify, this MSF as it is called, the multi-scheme framework as it is called. And then we'll also talk a little bit about the schemes that have been launched by HDFC Pension under the MSF guidelines. So we'll talk about that as well. I also have my colleague Vishwas Katela, who is the Chief Investment Officer, who will talk about the schemes, and he will also talk about the high-level investment philosophy that we'll be following, but that we have had as an organization, as a pension fund for the last 12 plus years, and the approach that we're likely to follow, intending to follow on the two schemes that we've launched, the three schemes essentially, but under two names that we've launched these three schemes. So that is a background. Once again, a very warm welcome. Just as a background, the multi-scheme framework, as this is being referred to, is been sort of in the works now for the last couple of months. PFRDA, who's the regulator for NPS as a product, has been having extensive dialogues with the pension fund industry, various players in the pension fund ecosystem, not just players in the pension fund ecosystem, but also players outside the pension fund ecosystem to seek feedback on various aspects related to the pension fund and the NPS as a product. And I think a lot of these changes that you will see, that we will talk about eventually, are changes that have happened within the current framework, which is as per the current PFRDA Act. A lot of these changes are within the Act and what the Act enables PFRDA to do. So it's a very progressive move by PFRDA under the leadership of the chairman who took over in the month of June, Mr. Sriram. He has acted as a real, he's sort of driven all of these changes very passionately, and with the intent that they should help us grow the pie. And as you will know, as a product, HDFC Pension has been, of course, in this business for the last 12 years. but NPS for all citizens or for the non-government sector has been in existence now for a while. We've been in the business of NPS now for the last, if you look at this timeline, in 2004 is when it was launched for the government employees. Eventually in 2009 it was opened up for all citizens, as it is called, and then in 2011 it was opened up for corporate employees, and there was a specific dispensation that was given such that individuals could contribute a certain part of their basic salary towards NPS, and they were also given a tax dispensation on the amount that was invested. So that happened in 2011. Between 16 and 19, a number of other new features got added, including eNPS, which is the platform that is operated by the National Pension System Trust. And all the three CRAs offer that platform. So that's a digital platform where you can open an NPS account. There's also digital KYC, which was enabled in this time period, where as we speak, as of today, when anybody wants to open a PRAN, it's as simple as 1, 2, 3. What do I mean by that? If you have a CKYC number, which is the case for a large number of our clients, most Indians, a large number of Indians who invest in financial products, or those that have a bank account, end up having a CKYC number. So a CKYC number is sufficient for you to open a PRAN account, which in itself takes under 3 to 4 minutes. So the entire digital architecture works very well, not very widely known, but it works exceptionally well. And also there is portability across retail, corporate, and so on and so forth. Between the year 2020 and 2023, we saw heightened awareness of NPS thanks to some campaigns that were done by points of presence. HDFC Pension, as you will know, is a pension fund manager. On the fund management side, it is also a point of presence, which is essentially focused on the business of distributing NPS as a product, or heightening awareness of NPS, and therefore helping individuals, corporates, and corporate employees to sort of onboard onto NPS as a product. So it did see significant growth in the year in the 2023-24 timeframe, and in 2025, which is as we speak, on the 1st of October, which is celebrated as NPS Divas, and the International Day of Older Persons is celebrated in India as NPS Divas, and the PFRDA and the chairperson used that opportunity to launch all of the schemes under the multi-scheme framework. So that's the background, that's the kind of timeline and history of how we've got to where we've got to. My own view, and I've been associated with the industry for some time now, my view is that this should help us get this product to more and more Indians. This should help us expand the number of people that have who have looked at NPS but possibly have not started the journey on NPS, and hopefully the new schemes that we will talk about and the flexibility that these schemes come with will attract more and more Indians, because one of the big challenges that we as a country face is the fact that while we are a very, very young country at this point of time, there are still around 12 crore Indians who are above the age of 60. This number is likely to more than double in the next 22 years. By 2047, 2050, it is estimated that there are going to be upwards of 30 crore Indians who will be above the age of 60, which means that 1 in 5 or 6 Indians will be, above the age of 60. It is something that we need to address, and it's something that we need to really take charge of and make sure that we address this. Because we have demographics on our side, we have time on our side, and therefore it's important for us to address this potential issue of social security. And therefore, NPS as a product becomes exceptionally important to help individuals build a corpus which is sizable enough, which gives them dignity, which makes them feel secure at the time of superannuation or retirement, as the case may be. And I think that's the background with which this whole, this whole MSF framework that has been put in place, and the fact that it will help more and more Indians come under the umbrella of NPS. So that's really the big focus, and I do hope that today's session helps you get a better understanding of the multi-scheme framework and the options that you will have thereof, and more and more people, and those of you who are already not already NPS subscribers, consider becoming NPS subscribers, because we do believe that this is indeed a product that is, in our opinion, best suited to create a retirement corpus. Let me move forward, and I'll quickly touch upon broadly the 7 key points that the multi-scheme framework essentially addresses. The first is obviously top right-hand point is what I'm referring to, which is the schemes launched by pension funds. So essentially, till now, as you will know, the framework that was available to a subscriber was essentially in the form of investment in tier 1 or tier 2. Within tier 1, you had an active choice option or an auto choice option. Under the active choice option, you as a subscriber could choose your allocation towards equity, corporate bonds, government securities, and alternate assets. And in the auto choice option, you had a automated tapering off of equity as age progresses. You had a conservative, moderate, and aggressive option in the auto choice option under the tier 1. And then there is tier 2, which essentially helps you. It is essentially like a wealth management account or a savings account, if you were to call it that. And you could be at 100% equity, 100% fixed income there, and use it as a there were no tax advantages in tier 2, but it was essentially an account that you could use to basically manage your short-term surpluses. That is the current set of guidelines. So those were the current set of guidelines that existed till 30th of September. Under the multi-scheme framework, the first thing that has been enabled by the regulator PFRDA is that each pension fund can now launch their own schemes, right? And under that enablement, each pension fund, there are 10 pension fund managers in India under the NPS framework. Each of these 10 pension funds have launched their own schemes. Of course, you will get to read about each of these schemes in the respective websites, and I would encourage you to look at each of the schemes that have been launched by my industry colleagues, so that you get a better understanding of the entire basket of options that are available to you as a subscriber. So that's the first change, right? So pension fund companies going forward can launch schemes on their own based on their assessment of what is the need that they're wanting to fulfill. So for instance, HDFC Pension launched 2 schemes that we will talk about in greater detail slightly later. But the first scheme that we launched enabled an individual to get 100% allocation to equity under the equity advantage fund, as it is called. And as I said, Vishwas, my colleague, will talk about it slightly later. And there's another balanced fund that we launched, which is essentially a hybrid between equity and fixed income. And that's a 55-75% equity range, and the remaining is in the form of fixed income. So it's a combination of equity and debt, where the asset allocation management will be done by the fund manager. And then there is a 100% equity fund that's available to you. So essentially, like this, the way I explained to you on the 2 funds that HDFC Pension has launched, every pension fund has their own set of, they've used their own philosophy, their own belief, their own understanding of the segment that they want to address, and they've launched their own schemes. So that's the first enablement that's happened. The second enablement, and I spoke about it briefly, is the fact that in these schemes, we can go up to 100% allocation to equity, which means that under the equity advantage fund that I spoke to you about, 100% of the allocation can happen to equity. Why is it important? It is important because under the previous framework, which continues to exist, by the way, under the previous framework, an individual could take at best a 75% allocation to equity, even in the active choice scheme. So again, 75%, you could go right up to 100% in terms of allocation to equity. And this makes a lot of sense given the fact that more often than not, retirement journeys of 20, 25, 30 years. And when you have such a long time frame with you, if it is prudently managed, then the likelihood of any capital loss is almost zero. And the likelihood of you making a double-digit return, which is inflation beating, is very, very high. And therefore, the very strong case for larger allocation to equity. So this enablement allows individuals to choose schemes which have 100% allocation to equity. This is the second one. The third, important change that has happened is, thus far, all the schemes that were there under the earlier regime, which are referred to as common schemes, and for the sake of ease, I will refer to the earlier set of schemes as common schemes. So the common schemes had a requirement for you to stay invested till the superannuation, which was the age of 60 or 58, as the case may be, because in some organizations, the superannuation age could be 58. So at the age of 58 or at the age of 60, depending upon what's the superannuation age, and in case of a retail self-employed individual, it was 60. So at the age of 60 is when you could exit from NPS, right? So if one entered into this product at, let's say, the age of 25, you had to wait till the age of 60 for you to exit from NPS. Under the new dispensation, each of these schemes that are being launched can potentially have a vesting period of 15 years. What does it mean? It essentially means that an individual who gets into this product, let's take the example of HDFC Equity Advantage Fund, which is a scheme under the multi-scheme framework that's been launched. It has a 15-year vesting period, which means that if somebody were to get in at the age of 30, then at the age of 45, the corpus that has got accumulated is available to the individual for exit, right? And that exit, the guidelines for exit are the same as it is today, which is 60% lump sum and 40% has to be used for purchase of annuity. So therefore, you don't necessarily have to wait till the age of 60, but you can actually exit NPS at the end of the vesting period under that scheme. Most of the schemes that have been launched, in fact, all the schemes that have been launched under the multi-scheme framework have a 15-year vesting period, which means that you have to wait for only 15 years for you to get the money out and exit from NPS as a scheme. That's the third important change. The fourth change, which is possibly more important from a subscriber's perspective, is that thus far you could only hold one scheme, right? Which means that if you opened an NPS account and if you, let's say, went into the aggressive option under auto choice in tier 1, all the money that you invested would essentially end up going there only. In the new scheme of things, the reason why it is called the multi-scheme framework is because of the fact that as an individual, you can choose to hold multiple schemes. You could choose to hold one of the common schemes, which is from the schemes that existed and continue to exist, the schemes that were there before, and you could hold a combination of new schemes. You could hold a scheme from HDFC Pension, you could hold a scheme from one of the other pension fund companies, you could potentially have 8 or 10 schemes that you hold. Why is it important for you? It is important because it gives you flexibility. It gives you the ability to choose various styles of fund management. I just want to make one point. What we will do is that we'll take all the questions. Please continue to keep sharing your questions on the chat box. We will address all these questions towards the end, if you're okay, because I just want to make sure that I complete all the key aspects before we get into the Q&A mode. So please allow me to. As I said, please continue to putting in your questions in the chat box, and our team is taking note, and we will address each one of them. So multi-scheme framework means essentially as a subscriber, you can hold multiple schemes, right? Which means that you could potentially hold 3, 4, 5, 7 schemes. It could be a combination of new schemes and old scheme as well. That's the fourth change that has happened. The fifth change, that's the fourth change. The fifth change that I would like to talk about is that you will see that pension funds will now start innovating on various aspects. For instance, you will start seeing products which are attached to the pension scheme, right? So for instance, it allows pension funds to now going forward offer value added services along with the scheme itself. You could see things like will and trust services. You could see certain attachment products like, let's say, term insurance or health insurance being attached to the pension fund scheme in times to come. Of course, as of now, given the fact that everybody was very keen to get these schemes going, you don't see any of those at this point of time. But as time progresses, you will see that a lot of innovation will happen, and that's been enabled by PFRDA. The final point that is relevant, to this audience is that the charge structure under the common scheme, which is the schemes that have been in existence, since the inception, under that scheme, the fund management charge was charged separately from the assets under management. So it was being sort of charged from the value. And then there was a separate set of charges, which were essentially charges that were pertaining to account opening, transaction processing, persistency, exit, and so on and so forth, right? So there was a certain set of charges. So from a subscriber's perspective, you did not have a very clear idea of what was the total charges that you were paying. At different points of time, you're paying different charges. Having said that, it was still a very, very low cost. It still continues to be the lowest cost actively managed fund in at least the Indian ecosystem, I dare say globally as well. The change is that instead of fragmented charges, the POP charge, or the distribution fees, and the fund management fees have been unified. So there is a total charge of 0.3% on AUM that will be levied on the assets under management, irrespective of the asset allocation which is there in the underlying. Finally, which may not be very relevant for all of you, but pension fund managers will now be actively engaging with points of presence. to make sure that we are able to drive adoption of pension products and NPS through a wider set of audiences that we are wanting to cater to. So those are broadly the 5 or 6 changes that I thought are important and worth highlighting to you. I'll quickly move on to the next slide, and then, as I said, we will come back to the questions as time progresses. So what are the things that we've done, right? So essentially, as HDFC Pension, we've designed essentially 3 schemes. First is the HDFC Equity Advantage Fund. The HDFC Equity Advantage Fund is a tier 1 fund with 100% allocation to equity. And let me tell you that the investment guidelines or the investment universe that has been in existence continues as is. So we are allowed to invest in the top 200 stocks as per market capitalization on the National Stock Exchange. So that's the universe on the equity side that we can invest in. And on the fixed income side, of course, majority of the investment happens in AAA, and there is some dispensation to invest in A and AA plus. Having said that, the Equity Advantage Fund is a fund that we've launched where 100% of the allocation can go to equity. So 90 to 100% is in equity. We also have the ability to invest up to 5% in alternate assets. At this point of time, alternate assets, liquid alternate assets or mark-to-market alternate assets are InvITs and REITs, which is where we will potentially invest if there is an opportunity for us to invest. Of course, this is best suited for younger professionals who have a much longer, time to retirement. So it is ideally suited for that segment of subscribers. And of course, people who are older than that but have a high risk appetite and who look at this as a part of their overall portfolio, this product can work very well for them. The second product that we launched is what is called as a Surakshit Income Fund. Again, I'll request Vishwas to talk about in greater detail. But a Surakshit Income Fund is essentially a hybrid between equity and fixed income, equity, corporate bonds, and government securities. And it helps you, enter into a packaged product. If you have a moderate risk appetite, you may want to choose this product and make sure that, you're letting the fund manager take the asset allocation call, and you're essentially, not, sort of having to get involved in changing asset allocation between equity and debt and so on and so forth, right? So those are the 2 broad category of funds that we've launched. There is also a tier 2 version in Surakshit Income Fund, which I'm going to, skip at this point of time in the interest of time. But essentially, one is an aggressive fund that we've launched, which is meant for long-term wealth creation. Yes, there will be higher volatility given the fact that it's exposed to equity. And there is a slightly lower risk product, which is called the Surakshit Income Fund, which is a hybrid between equity and fixed income. So that's broadly, what the choices are. We will talk about the new schemes, and I'm going to invite Vishwas to talk about the new schemes. But in the meantime, should we take the questions now, or should we take the questions toward the end? We'll take it at the end. Okay. So I'm going to request Vishwas to come in, and he will sort of take charge of the next few slides.
Thank you, sir. Hi. Good evening, everyone. So I'll just briefly talk about the schemes which we have launched, the salient attributes of each of them, and also briefly talk about what is the idea behind launching of each of the schemes. So to start with, the Equity Advantage Fund, this is primarily the objective here of this scheme is to generate long-term capital appreciation, given equity is something which we feel is an asset class which over a longer period of time actually outperforms both debt and other asset classes. So this is for investors who are seeking higher exposure to equity, because the current common scheme only offer up to 75%. And also here the equity allocation is between 85 to 100%. Alternates, which will REIT, InvITs primarily, would be around up to 5%. And cash to cash equivalent is where we have put it at 10%. BSE 200 TRI will be a benchmark here. And exit, as Sriram covered earlier, is allowed after a 15-year of vesting period. Key point I want to highlight for subscribers here is basically 15-year is a sweet spot period, because our analysis of historical returns of last 35 years show that in a 15-year rolling period, the equity returns are never negative. They are always above 0. More importantly, 90% of the time, the returns in any 15-year rolling period is upwards of 10%. So the point I'm trying to highlight here is that when you are invested in an asset class over a long period of time, equity is a place which actually gives you much better returns, and which I'll show in one of the slides afterwards. In terms of withdrawal, post-vesting, it is determined by the PFRDA guidelines, wherein you can take lump sum or oblique SWP and regular income equity. Income tax benefits are up to as per the Income Tax Act, and as covered earlier, the total charges are capped here at 0.3% of AUM, and these are clear charges, and there are no breakup as such, apart from the CRA custodian and NPS trust charges. Coming to the next scheme, which is Surakshit Income Fund Tier 1. This is basically a hybrid scheme. Idea here is that the current dispensation, the common schemes, the subscriber makes a choice, and he or she is allowed to change it only once in 4 times in a year, and that too they have to be very vigilant about it. Here, the asset allocation will be something which the fund managers who are actively tracking the market day in, day out will actively take those calls. So in a time period of heightened volatility where they see there is a higher risk on the equity side, we can swiftly move into higher exposure into bond side and vice versa. So this is again a scheme which is for investors who are looking for diversification across multiple asset classes. At the same time, they are looking at a long-term wealth creation. Again, here vesting is over 15-year period. Post-vesting period, the withdrawal is as governed by PFRDA guidelines, and charges are similar to equity advantage fund. The third scheme, which is under Tier 2, this is basically a modified version of Surakshit Income Fund, where we have capped equity at 25%. The reason here is, again, there is no lock-in here. So we wanted to keep the volatility in this hybrid fund on the lower side, vis-a-vis the earlier scheme where when you're logged in for a 15-year period, given our experience with equities over last long 30, 35, 40 years of seeing the market and beyond that, the 15-year period is a good gestation period to offer you good returns. But here, given there is no lock-in, we have limited it to 25%, with the rest of the allocation going to bonds and alternate investments. Lastly, what is it? So on the equity fund size, we are offering a higher equity allocation, which over a long period of time, 15 years and about 30 years, can actually help you build a large corpus. And the Surakshit Income Fund side, we are offering you as fund managers dynamic asset allocation, wherein we as asset fund managers will be looking at the market dynamics and accordingly taking asset allocation call, whereby trying to reduce volatility of returns and through our active risk management. This will be diversified investments with regular review and rebalancing from our end. Lastly, I'll take you through this slide wherein we have done a simulation based on our 10-year returns of last 10 years. And if you project it on 3 schemes, LC50 under the existing common schemes, the Surakshit Income Fund, which is the yellow line, which is you're saying, and red line is basically the equity advantage funds. So if a subscriber remains invested in these schemes across 35 years of from age of 25 to 60, with the type of asset allocation which we have built in the schemes, the corpus can actually vary a lot. Given equity advantage fund with around about 14% equity returns, which we have seen in last 10 years, the corpus can be as high as 17.7 CR. While in Surakshit income scheme, wherein the equity is around 65% average, it will be about 12.5 crores. And in LC50, it would be 8.5 crores. Basically, a function of the asset allocation which are there in each of these schemes. With this, I'll just last point I just wanted to cover. In existing schemes, when you work with equity at 75%, vis-a-vis if I take the same returns and make equity advantage fund with 100% equity allocation, over a 30-year period, if you do full equity 75 here and 100, our simulation shows the difference in your corpus between between a 75% equity allocation and a 100% equity allocation would be about 20-21%. So that's the type of difference which can be generated with a higher equity allocation. Yeah, with that, I'll hand it over to Sriram, sir.
All right, I'll just take a couple of more minutes to sort of give you a quick overview of what's our journey, and I'll then take the questions. I see a bunch of questions that have come up. So I'll try and answer as many questions as we possibly can. Most likely, we should be able to address all the questions that I saw just now. But just a quick summary of where we are and where we started from. We started in the year 2013, and from FY13, FY14, we were at 6 crores of assets under management, and as we speak, we are north of 1,40,000 crores of assets, 1,39,946 as of end of September 2025. Thank you very much on behalf of the team. This constitutes around 26 lakh subscribers across various segments of the market. So as HDFC Pension, we are really, really grateful to all of you for having reposed your trust in us. And we will make sure that we continue to live up to the expectations that you would have from a fund house like us. And of course, we also have a very, very stellar board that backs the business. Of course, you will see that there are four independent directors, 3 directors from our promoter company, which is HDFC Life. Mr. Bose, the first of the independent directors, you'll also know from a Bose committee report that he chaired. I mean, it's a committee that he chaired, and the very, very important set of reforms in the financial services sector that were kicked off on the back of that. He's there on our board. Mr. Ranjan Mathai, who's also the ex-ambassador to UK from India. He's on our board. Mr. Kandpal, again, very, very long and storied history, storied career with SBI, and then, he retired as the MD and CEO of SBI General Insurance. He's on our board. Mr. Ranganath, who was the ex-CFO of Infosys, is also on our board, and he also chairs the Catamaran Ventures Fund that Mr. Narayan Murthy's family office. And then there is Vibha, who's the MD of HDFC Life. She's on our board as well. Mr. Neeraj Shah, who's the CFO of HDFC Life, and then Mr. Vineet Arora, who's the Chief Distribution Officer, Chief Business Officer of HDFC Life, is also on our board, and of course I sit on the board too. So that's the board constitution for your. I thought it was an opportunity for us to also introduce our board to you, so that you're familiar with the set of people who are overseeing this business. Of course, I have a team of over 350 people that work with me in the pension business, and thankful for all the work that we've been able to do. Finally, final slide, and then after that I will take the questions. So HDFC Pension is the only pension fund manager which has a scale presence in both sides of the business. When I say both sides, there is the pension fund management business where I told you we have almost a 43% market share, above 43% market share in terms of all the money that is there in the retail and the corporate space. And we are also a large point of presence. What does the point of presence do? The point of presence responsibility is to make sure that we are able to onboard more and more people onto the NPS ecosystem. So we work, primarily on the corporate NPS, and of course we have a retail NPS presence as well. So we work with over 4,120 corporates as we speak, and close to 5.5 lakh subscribers on the point of presence side as well. So that's really, so we are there on the acquisition, getting Indians on the NPS ecosystem, and then managing their money and helping them build a meaningful corpus through their lifetime. So that's really what we do. I'm going to stop here and take the questions. I'm just going to quickly, go over the questions on my mobile. So please allow me a minute or so that I'm able to read through the questions and try and bunch up common questions and address them together. So let me just I think this I'll try and explain some features of this architecture so that some of these questions will get addressed if you were to if I were to explain this. So firstly, the common schemes, these are the schemes that have been in existence for the last many years now, the tier 1 and tier 2 architecture as it exists. The common schemes continue to exist, and they continue to be available to investors to subscribe to. Most of you who are already in NPS will potentially have your investments in the common scheme tier 1 and common scheme tier 2 possibly, right? Now the exits for the money which is there in common schemes tier 1 are determined by whatever is the exit and withdrawal regulation that PFRDA has. As we speak, that is a superannuation age of 60 or 58 as the case may be. Wherever the retirement age is 58, it is 58, otherwise it is 60. So at the age of 60 is when that money, you can exit from NPS. And at the time of, and this is called normal exit. Normal exit from NPS will entitle you to 60% as lump sum. You can claim 60% of the total corpus as a tax-free withdrawal. It is called a commutation amount. And the remaining 40% has to be used for purchase of an annuity. That's the normal exit. So all your existing T scheme and existing money in common schemes will be met with this treatment, which means that you will have to wait till the age of superannuation for you to exit normally. Of course, you have the exit option prematurely as well. If you want to exit before the age of 60 or 58, as the case may be, you do have the option of getting out before that. However, you will be only eligible for 20% of the corpus as commutation amount. The remaining 80% has to be used for the purchase of annuities. That's the current exit guideline for the common schemes. That does not change. So related to that is the question that one of you have asked, where you said, can I move my money from common scheme to the new scheme? The answer to that is no. What you can potentially do is continue to maintain the common scheme. Whatever money you have in the common scheme can continue to remain there. Of course, within the common scheme, you can make changes in asset allocation. You can move across fund managers. You can choose different fund managers or different asset classes and so on and so forth. But you can't move from a common scheme. The money that is there in the common scheme continues to remain in the common scheme. The money in the MSF that you will be able to invest will be the incremental investment that you want to make, right? And therefore, all the monies that comes into let's say MSF, as it is called, the multi-scheme framework or the new schemes, will have to be fresh incremental monies that you choose to invest in NPS. I hope that answers the question. A few questions which are around. Yeah. Why don't you do that? Just allow me 30 seconds. We're just trying to open the questions on the laptop itself, so I'm able to address the questions right here. Yeah. All right. There are other very pertinent questions on why somebody would want to, why would somebody want to have multiple brands? Very, very good question. So you can potentially hold multiple schemes within the same plan. You have the option of opening another plan with another CRA. Now, you may not want to do that, right? There are some situations that may warrant this to happen because, for instance, if there's a government subscriber today, a government subscriber would have his permanent retirement account number with one of the CRAs which have been chosen by government as the chosen CRA for government subscribers. If that individual chooses and wants to invest in, let's say, the multi-scheme framework, is this working? Because this has gone on. Is it working there? Because this one has gone on. I think there is a problem here. Oh, that's gone. Sorry. Okay. So a government subscriber could potentially have a situation where they are locked into a certain CRA and they may need to open another account so that they're able to invest in the multi-scheme framework. So that's the reason why the multiple plan framework does exist. Can a subscriber invest in two different schemes of the same category? Absolutely. By two different PFMs under the same plan and CRA? Absolutely. So every CRA will have all the schemes listed there, which means that every single scheme under the pension, under the multi-scheme framework will be listed in the CRA website. I just want to make one small, clarification here. As you will know, the pace at which this has happened over the last 2 to 3 weeks, there is some bit of tech development that is still WIP at the CRA end. And therefore, you will see that some of these features will be available to you maybe 2 to 4 weeks from now. So you will have to allow it some time because the CRAs have also been sort of out of breath. They've been sort of working overtime to make sure that they're able to get this live. So as we speak, all these 3 CRAs have the ability to, onboard a new customer and let that new customer choose the new schemes. For existing subscribers, the ability to choose investment in new schemes at this point of time, there are limitations that are there. Not all 3 CRAs currently offer that. So therefore, please allow this another 2 to 4 weeks and you will be able to exercise some of these options that you would want to exercise. I'll just quickly go through some of the other questions. Switch transfer from funds from existing schemes. As I said earlier, common scheme funds continue to remain there. Your incremental money is where the new schemes, potentially your new money can go into these new schemes. Where can we find the asset allocation, investment objective, and other details of the new schemes? You'll find the scheme brochures in each of the pension fund companies' website. You will find ours in the website as well. We'll also put it on the chat. If you can put it on the chat, the brochure, you could possibly look at it, download it, and keep it with you. There's a question on corporate NPS 8 months back. How can I use other schemes? Yes, you can. Again, as I said, the CRA enablement to make sure that as a corporate subscriber, you're able to, let's say, start investing incremental contributions entirely to the new schemes, or partly allocate some money to common schemes and partly to the new schemes is WIP. It is something that you will see within the next, I'm confident in the next 4 weeks. All of these enablements you will see in the CRA portal, and our RMs will also be wherever HDFC Pension is the point of presence. If they are working with your corporate, if you're a corporate employee, and if we are the chosen corporate NPS POP provider, we will be able to make sure that we enable this for you. At this point of time, as I said, the CRA systems are still playing catch up, and I think it's a matter of 2 to 4 weeks by when this will be addressed. There's a question on I'm unable to modify the equity allocation under scheme E to 100%. Yes, you will not be able to under the common schemes. 75% max allocation to equity, the limitation continues. What do I mean by this? What I mean is that under the common schemes, the way the common schemes operate, there is no change in the way common schemes operate. By which I mean that in an active choice under common scheme, tier 1, you can only have up to 75% allocation to equity. If you want 100% allocation to equity, you may have to choose one of the multi-scheme framework schemes launched by, like for example, the HDFC Equity Advantage Fund, as I said, has 100% allocation to equity. You could choose that, but that's for incremental monies. The existing common schemes will continue to have a limitation of 75% under the active choice. I've joined NPS after attaining the age of 55. When can I take pension? You're eligible to buy an annuity scheme at the age of 60 or thereafter. What do I mean by that? Let's say you have accumulated, and there's a gentleman who said, I have got into the scheme at the age of 55, which means that starting 55, let's say at the age of 60, you have an opportunity to exit normally. What do I mean by normal exit? On exit, you get 60% commutation and 40% you will need to buy an annuity. But the current architecture allows you to continue holding on to your corpus, and without even having to invest incrementally, you can continue to hold on to this corpus till the age of 70, and you can contribute till the age of 70, and you can actually exit at the age of 75 as well. So even if you are entering at the age of 55, there is absolutely no problem. You have an option to exit normally at the age of 60, and then of course you can choose to exit subsequently at any point of time. Our PSU employees like REC Limited, can they increase their asset allocation in equity? As I said earlier, absolutely, it will be available to all non-government employees for their corporate contributions as well as for retail contributions that we may want to make. But as I said earlier, you will have to just allow us some time, because the CRA systems are getting ready so that we are able to accept the entire corporate contribution into the new schemes, or a part contribution to new scheme and part contribution to the old schemes. All right. So I think there's a question on market risk or fixed returns. I just want to, make it clear that NPS is a market-linked product. There are no guarantees that are offered under the NPS architecture. The risk of volatility continues to be there. If you have an allocation to equity, there will be a risk of volatility. But I also want to make it, I just want to sort of highlight the fact that there is no better goal than retirement to allocate equity to, which means that, you typically start reasonably early. If you start fairly early, you can actually maximize your allocation to equity so that your ability to deliver double-digit return, the product will, most likely deliver a fairly strong return, and you're able to therefore, generate a significant corpus. So, so to that extent, I think it makes eminent sense for you to take allocation to equity. But of course, I want to also qualify that it's a matter of individual preferences and risk appetite. But essentially, in my opinion, it's a very, very strong asset class. All right, so there's a question on changing asset allocation. Now, asset allocation change can be done in the existing common schemes. Can you do it today? Yes, you can. Within the framework, you can. So up to 75% in equity. Let's say today you have a 30% allocation to equity or a 25% allocation to equity. You can up it to 75% allocation to equity. Let's say you are in LC25, which is the conservative plan under the auto choice. You want to move to the active choice. You can move by all means. You can actually do this 4 times in a year. It's not very well known, but actually you can change your asset allocation 4 times in a year without any cost, without any tax implication. This is the only product which offers this level of flexibility. You can change your fund manager once a year at zero tax, zero cost. So there is flexibility in the common schemes for you to, move asset allocation, move fund managers as you desire. Under the multi-scheme framework, once you get into the product, you can only move back to the common schemes. What do I mean by that? Let's say you started investing in, let's say, a particular product under the new scheme, multi-scheme framework. At some point of time, you desire to come out of it for whatever reason. When you come out of it, the only scheme that you can come out of it to is the common scheme, which is, let's take an example of HDFC Surakshit Income Fund. Let's say you got into Surakshit Income Fund and you had a 15-year time horizon, but at the end of 5 years, you want to get out of it and get into, let's say, get back into the tier 1 scheme of HDFC Pension or to any, for that matter, any other pension company. You can do that, but you can only move from the new scheme to the common scheme. You can't move from new scheme of pension fund A to pension fund B to pension fund C, right? So that's the clarification that I wanted to make. The question on, can I ask out of the 14%, can we ask an employer to put 5% in common schemes and 10% in new schemes? By all means, you can. Whether you will be able to do it as absolute figures or in percentages is the function of what typically the employer allows and what the employer payroll systems allow. But it is most certainly possible. You can define a certain amount going into common scheme and a certain amount of money going into the new schemes. Certainly possible. There's a question on investment proportion for age greater than 50 as per this presentation. I just want to again clarify that the age-based asset allocation is a part of the common scheme, which is the older schemes. There are what are called as auto choice options where the asset allocation keeps getting reset based on your age. So let's say from the age of 35 to the age of 55 in the 3 auto choice schemes, which is conservative, moderate, aggressive, the asset allocation starts tapering. The allocation to equity starts tapering to a smaller number by the age of 55. In the balanced life cycle scheme, which is also an auto choice option, the tapering starts from 45 to 55. So the tapering of allocation to equity happens in the common scheme under auto choice. In the new schemes that we're talking about, at this point of time, there are no schemes that are there launched by any of the pension fund companies where there's a tapering of asset allocation to equity as you near retirement. There could potentially be funds like those which will get launched, but we'll have to give it time. There are what is called as target date funds that typically you would have seen. Those of you who are familiar with the US market or developed country markets, you will see that there are target date funds. You will see that some of those some of those funds will get launched in times to come. And there you will see an opportunity. There you will see that there is a tapering that happens from as we get towards the target date, allocation to equity may potentially come down. When we switch a fund in NPS, does the existing corpus get converted as well, or only the future investment can get changed? Again, within the common schemes, if you change from asset allocation 1 to asset allocation 2, the entire corpus shifts. While in case of new schemes, when you start investing in a new scheme, the money goes into the new scheme. There is no question of old and new because whatever incremental money, only that can go into the new scheme. I hope that answers the question. Excellent question again. NPS introduced a retirement product. How will the 15-year choice or redemption help in that aspect? I completely agree with you. The longer you stay invested, higher is the chance for you to be able to create a meaningful retirement corpus. Now, the reason why this 15-year option was introduced is to make sure that people have an option, right? Because at the end of the day, I think the product needs to offer as much flexibility as possible, but within broad timelines. And as you will see, the reality is that if you give 15 years to equity as an asset class, it actually ends up giving you 85% of the times or more, it gives you double-digit returns, right? So I think this 15-year vesting period has been put in place after a lot of thought. I agree with you. So at the end of 15 years, let's say somebody got into this product at the age of 30, at the age of 45, they have the option to vest. There is no compulsion, which means that you can continue to hold on till the age of 60 and exit normally anytime after 15 years of age. So there is no compulsion. It's an option that is available to you to vest, to sort of take the money out after the vesting period, essentially giving an option to individuals. So from a fund choice perspective, there's a question on whether I can choose a particular fund since I'm of a particular age. There is no restriction. As a pension fund manager, we would want you to exercise due diligence to make sure that you understand the risks and the rewards associated with the scheme. We have no restrictions on taking money from people of whatever age in either of the schemes. There's a question again, I'd like to pick this up because it's interesting, because it says, how is it different from investing directly in any other mutual fund SIP? Does NPS have any additional level of advantage in terms of fund security as the returns compared to regular MFs are lesser in NPS? So I want to spend a couple of minutes addressing this topic. Let me first of all state that this product is not a competition to mutual fund. Like in a thali, you will have all kinds of dishes that will make up a thali. Similarly, a financial portfolio must have products of various kinds. Every product will have its own positives and some limitations, right? And with that as the caveat, let me also state that in our belief, we as pension fund managers believe that NPS should be the foundational product for every individual, because this is the only product, or this is the only goal that where you can't take a loan against. Every other goal that you have, be it buying a house, buying a car, or anything for that matter, you possibly will get a loan for you can borrow against that for that particular goal. Retirement is one goal for which you're not going to get a loan, and therefore it is important that each and every individual starts saving for retirement right from the first salary, right? So that's the first point. The second point is that if I were to get into a comparison between mutual funds and NPS, there are things on which mutual funds will score over NPS. There are a lot of things on which NPS will score over mutual funds. All I want to talk about is that just keep three things in mind. Number one, it gives you active fund management at a very, very low cost. At 0.3%, you're getting access to active fund management. And you heard my colleague Vishwas and his team, who are exceptionally well qualified to manage your money, right? Number two, the tax advantages as a corporate NPS specifically that you get under the lower tax regime for a non-corporate employee, there are tax advantages that are available, which is something that is unique to NPS. Point number three, this product forces you to remain invested for a minimum of 15 years. The probability of you making significant returns when you stay invested for 15 years and you don't have the risk of succumbing to noise, which is typically what happens in other open-ended market-linked products, where you tend to react when the market were to, let's say, and the market will be volatile, right? Because that's a feature of the market. That's not a bug, it's a feature, right? Every year, over the last many years, you've seen that the market at least once or twice will correct by more than 10% in a year, right? So that's a feature of the market, not a bug. And therefore, this product protects you from acting against your own worst instincts, and therefore it protects you from coming in your own way of creating large corpus over a long period of time. I think this is by far the most underappreciated feature of this product. 15 years will make sure that you make a meaningful return from this meaningful corpus out of this product. Finally, I want to talk about the tax advantage at the time of exit. As you know, 60% of the corpus that you have put together is available to you completely tax-free. The remaining 40%, you have to buy an annuity as we speak. There is a consultation paper that is out. I would encourage you to read it because PFRDA website does have the consultation paper. It's called the Exposure Draft on Exit and Withdrawals. It actually proposes that the 60% commutation should move to 80% commutation. Only 20% needs to be used for buying an annuity, which means that NPS is the product. If those were to go through as a regulation, and we expect it to sort of we are optimistic about it going through. If it does, 80% of your corpus is available to you lump sum. 60% is tax-free. The remaining 20% may attract tax. That's still sort of unclear. But for a moment, let's assume that there is a tax on the remaining 20%. The remaining 20% you buy an annuity. So to that extent, I think it's a very, very powerful product. It's got some features which are truly unique, other than the fact that it's a very, very low cost product. I hope I've been able to address. Yes. So there's another question that's come in on when a company enrolled for an NPS corporate plan without the consent of the employee, all funds have been moved from Fund A to Fund B. I'm not naming it for obvious reasons. I understand POP can be HDFC, but a fund manager can be anything. Why was this done? So let me explain this to you. So there is a point of presence, which is nothing but the entity which is helping your company and you as an employee to open the account and for any service request that you may have with respect to that particular NPS account. The POP does not have any say in the pension fund manager that you choose. So HDFC Pension point of presence, we have customers who have chosen other pension funds as their pension fund manager, and we are absolutely fine with it, because our role as far as the POP is concerned is to help the customer manage the money, help the customer in servicing of his corpus, of his account, right? If the customer has chosen some other pension fund manager, that's their choice, and we are more than happy. We respect the choice that every individual subscriber makes. So there is no compulsion that you have to be with only XYZ as the pension fund manager if XYZ is the point of presence. It's completely, the architecture is completely open. There's a question on if I have held my NPS account for 16 years as per the new process, I can withdraw the corpus amount. The answer to that is no. I just want to clarify that the 15-year vesting period is applicable for the new schemes. For existing schemes, the vesting age is the age of 60 or 58. In case the retirement age in your company is 58, then it is 58. Otherwise, it is 60 for all retail subscribers as well as for corporate subscribers where the superannuation age is 60. At the age of 60 is when you will be able to exit. Under the new schemes, it is 15 years or your superannuation, whichever is earlier. Let's say you got into a new scheme at the age of 50. You don't have to wait for 15 years. You can exit at the age of 60 because 60 is your superannuation age, is your exit age, right? So at the age of 60, you will be able to get out of the scheme with a 60-40 allocation, 60-40, 60% in commutation and 40% in annuity. Yes, I can see some questions around the schemes not visible. As I said earlier, request your understanding and patience. The things have moved very fast, and I know that ideally all of these things should be available on the CRA portal at this point of time. But I'd request you to be patient. Give the CRAs another 2 to 4 weeks. The entire ecosystem is working to make sure that all options are available in all the CRAs, so that you're able to sort of exercise your choice as and when it is available. Yeah, can corporate contribute into a special scheme as extend tax advantage to the individual? Yes, see the 80CCD 2B section under which the corporate employee is eligible for a tax deduction up to 7.5 lakhs, 14% of basic under the new tax regime and 10% of basic under the old tax regime, is available for common schemes and the new schemes, right? So to that extent, all the schemes that are there under tier 1 are eligible for tax advantage, at the time of entry as well as at the time of exit, which I explained earlier. Will there be 2 equities, one from a common scheme and another from MSF? Absolutely. That's a fantastic question. And the answer to that is yes. At the time of your superannuation or as and when you choose to exit, that amount, 40% of that amount, if it is a normal exit, you can use to buy an annuity, and you could therefore, if you exit at different points of time in different schemes, you can buy annuity at different points of time. You could potentially bunch them up together as well, right? There's no compulsion. You could sort of make sure that you exit from all the schemes, provided you completed the vesting period or the exit age on all the schemes, and you can actually exit from all of them together. There are some questions on the calculator. Yes, there are a number of calculators that are available. In fact, we are launching a new website in the next couple of weeks, you will see a very interesting calculator. But as we speak, there are calculators that are available on our website, on the NPS Trust website as well, and if on various other public calculators. All of those calculators will give you the ability to sort of tweak around with percentages and understand what the final income will be, final corpus will be for you potentially. Excellent. I think we've pretty much covered all questions, unless Ayush, if there's anything that I'm missing. Okay.
Yes, people have also
management and administrative fees. Sorry, there's some questions on management. I told you about the fees. It's 0.3% of the assets under management that will be charged from the NAV. So the NAV that you will see on the new schemes will be net of this 0.3% per annum. There are some small charges that will be recovered for CRA and so on and so forth. That's 100 rupees and 150 rupees per year. Very, very insignificant amount of charge that will be recovered by the CRA. Other than that, all the charges that we spoke about earlier. There's no account opening charges in the MSF. There are no transaction fees in the MSF. As you will see in common charges, common schemes, every time when you open an account, you would pay anywhere between up to 400 rupees. Every contribution that you made, you would be paying 0.5% of the contribution made, or as per the agreement that your company would have entered into, in case you're a corporate sector employee. Some of them would have got preferential pricing, but all of that goes away. In MSF, the only charge that you're paying is 0.3% on the assets under management, and that will be recovered from the NAV. So to that extent, you're getting a net of cost. Whatever is NAV is net of cost. Any other questions that you're seeing, Ayush?
People have answered, sir. So our team has also answered. Sir. Excellent. Does the equity percentage reduce with age?
Yeah. I think that is that.
Answer. Mostly answered.
How do we merge individual and corporate NPS? Well, I think there are, the process is fairly, actually at this point of time, you can only have one of the two. So you can potentially, if you're an individual and you want to move to corporate and you're a corporate sector employee, I think you should speak to the payroll folks in your company, and they'll be able to guide you on how to move your, in case they don't have corporate NPS in the company that you work in, please reach out to us. We'll be more than glad to get the company empaneled into corporate NPS and enable the whole process.
Can we open corporate NPS offline at HDFC Bank?
What is that? Yeah, corporate NPS is something that you need to talk to your payroll folks about. It's an enablement that happens at a corporate level. So when you want to open a corporate NPS account, the person to speak to is the HR folks in your organization. More often than not, corporates have there are some 21,000 corporates as we speak who have empaneled for corporate NPS to offer corporate NPS to their employees. In case there is your employer has not signed up for corporate NPS, as I said, corporate NPS, we are the largest corporate NPS point of presence in the industry, and we'll be more than glad to assist your corporate in helping them get onboarded onto the NPS ecosystem. Yeah.
If we do contributions in the new scheme, would we be required to make contribution to the older scheme as well?
There's no compulsion. You have to contribute under tier 1 for the account to remain active. It needs to see a contribution of 1,000 rupees per annum. That's the only requirement. It could be in the new scheme, it could be in the old scheme. By the way, you may choose not to contribute for 2 or 3 years because you may have other goals that you're sort of investing towards. As and when you want the account to get activated, they are as simple as contributing 1,000 rupees into the tier 1 account, and the account will get activated.
One more question, sir. What will happen at the time of exit when employee having multiple plans or multiple schemes having fund in each plan? So
as I said earlier, it will be guided by each of the schemes in terms of what is the vesting period. In case you have crossed the age of superannuation, then you can choose to exit from each of these schemes at a time of your choosing. If you are below the age of 60, then you will be governed by whether that scheme has completed its vesting period. As I said, all the schemes that have been launched under the new scheme framework by all the pension fund managers have a vesting period of 15 years. So therefore, 15 years is what you need to stay invested in for you to normally exit from the scheme. If you want to move out of the scheme, you have the option of moving back to the common scheme. I think I mentioned that earlier. You can move to common scheme tier 1. And then from there, you can obviously do a premature withdrawal if you so desire, or premature exit if you so desire. Any other questions?
They're not able to download the brochure, so I've asked them to
All right.
do the
Yeah, so if you could share your email IDs, we'll make sure that we get the brochures across to you. We've spent an hour and 2 minutes. So I'm going to take a pause here, and if there are any final questions, we'll try and address them. If there aren't any, we'd like to express our sincere thanks to you for dialing in. I do hope the session was useful, and we'll be more than happy to, and the recording of this session that we will put out as well. And we will do a follow-up of this sometime in the coming week. So, let those of you, friends who have not been able to join today, you can share the recording with them. And, or of course, we'll do a follow-up session so that, we're able to get the word out to as many people as possible in terms of what the flexibilities available under the new scheme are. You're doing the next one on 15th? Okay, 15th of October is when we're doing the next session. And we will send out invites for that as well, and the dial-in links as well, dial-in details as well. Thank you once again. Thank you. Really appreciate your time, and I do hope it was of value. And at HDFC Pension, we continue to remain committed to working very closely with all our subscribers and making sure that we are able to help you retire with pride. Thank you very much. Thank you.